So you have heard me talk about a somewhat unknown financial product on the show in the past, and that is HEI or HEA, home equity investment or home equity agreement. And this is an industry that is really gaining in popularity. It's been a little cottage industry. It's been around for a while, but few people know about it. I've talked about it on the show before. And the reason I think it is gaining a lot of traction is because, as we've discussed in past episodes, we have 25% of the country that has a mortgage at or below 3%. 65% of the country has a mortgage at or below 4%. And I think somewhere around 80% has a mortgage at or below 5%. They don't want to give that up. They've discovered that underlying mortgage they have has become an incredible asset that cannot be replaced because the cost of money is not very negotiable. It's pretty much a set deal, within a very small range. And that's why there is a way to unlock equity without losing that first mortgage. And this is the lock-in effect. This is why the real estate market has been in sort of this period of stagnation the last few years, because people don't want to give up those cheap mortgages. So here to talk about that today is the founder and CEO of Splitero. They are an HEI company, and that is Michael Gifford. Welcome. How are you?
I'm doing well. Thank you for having me. Yeah, all of that rings true to my ears. We talk about that day in, day out here at Splitero.
Absolutely. So you're coming to us from where I used to live, La Jolla, California, beautiful place. And tell us about Splitero and, kind of the problems it solves.
Yeah, as you kind of spoke about, Splitero is on a mission to help homeowners access the equity in their house without additional debt or new monthly payments. And we deal with a lot of homeowners in that exact scenario, right? They have two assets now. They have that house, and they also have a low rate mortgage, and they're trying to figure out how they access, in most cases, like 50+% of their home value as equity, because they need cash, right? They need cash to pay bills. They want to repair, renovate the property. They don't want to sell. They don't want to move on. And so we're really here to make that as easy as possible and offer an investment product called the HEI, as you mentioned, that is really a newer industry growing rapidly. And it's an alternative that anyone looking to access the cash in their house should consider, as opposed to a reverse mortgage, a cash out refi, a HELOC, or any other of the traditional debt options. We're a non-debt alternative.
Yeah, so that's a really unique selling proposition of the HEI world, is that there are no payments. Basically, what you are doing is you are selling as a homeowner, whether it be owner occupied or investment property, you are selling a portion of your equity and that future appreciation potential to get cash now. And the reason I like this and want to offer it to you, our listeners, as you've heard me talk about before, is that it would help you get this equity out to buy more investment properties. And that's what we do. So take us through the details of it. When I looked at this originally, started looking at it almost 2 years ago now, Michael, I noticed that unlike a conventional mortgage, there are many other factors. Conventional mortgage, you could just evaluate, if it's a fixed rate mortgage, you could just evaluate what is the LTV, what is the rate, what are the points, what are the costs, boom. What's the term? 30 years probably, right? Simple. But these are more complex, and understanding like how much it will cost you as the homeowner is a more complex equation. How much are you going to have to give up 5 or 10 or 25 years from now? Can you kind of help us understand that and unpack that?
Yeah, I would actually argue that it's easier than your traditional mortgage to understand.
Wow. Okay.
And some of the more tricky reverse mortgage HELOC products out there. Splitero makes it really easy. So we work off a 2 equity multiple. So we'll give you right now, let's just say $1 million house, we give you $100,000. It's 10% of the home value. When you go to repay, you'll pay 20% of the home value. So that. That is also the max that you'll ever pay. We also have a homeowner safety cap, which is an equivalent rate of about 19.99% per year. So you play the lesser of the two. If that home's still worth $1 million in a year from now, you'll either pay that 100,000 plus 19.99% or 20% of that home value, which would be 200,000, whichever is less. And so it makes it really simple for a homeowner to know what they're going to pay in the future. When someone comes to Splitero and applies, they'll also realize that the qualification process is much easier. So there's no income verification, there's no tax returns. We care more about the home and the value of that equity that's in there.
It's an asset-based product.
It's an asset-based product.
Like asset-based loans.
Yeah.
Yeah.
So we're also willing to help, homeowners with as low as a 500 FICO. And just a lot of traditional financial institutions aren't going to work with someone that has a, sub-perfect credit score and they don't have income that supports additional debt. And so I think it's actually easier qualification for most people to understand.
Oh, I agree. It's easier qualification. I just don't know that it's easier a calculation, right? Sure. And so a lot of these HEI companies, and we've been to the same conferences, you and I, on this through IMN, and they are sort of self-capping their returns because the regulatory environment on this is, the regulators haven't paid attention to this yet, right? Like you can't put a Dodd-Frank on this, right? And you can't put truth in lending on it necessarily. I don't know. It's like a different kind of product, right? It's not a loan. It's an investment. It's like an equity share deal. So that's the maximum. But let's do an example on that if we can. Okay, so you use the example for round number sake of a $1 million property. Okay, yep. And most of our listeners they've got $1 million home of their own or maybe more. But if they're doing their rental properties, their investment properties, those are cheaper. Those are $400,000 properties, right? But let's take $1 million for simplicity's sake. And say that homeowner has a $700,000 mortgage against it. So their current LTV is 70%. Can they get an HEI through Splitero for that?
They can. So we can go up to 75%.
Okay. So you'd give them $50,000 in that example.
Right. And that's a tough example. Your average homeowner comes to us right now with 50 to 55% equity in their house. So really they have 450 on that $1 million house. That's a more typical scenario that works.
Okay, but let's say it's for round numbers. Let's say it's 500,000.
Perfect.
So they own half the house. Yep. They've got a 50% LTV currently. So they've got 500,000 loan, 500,000 in equity, and they come to you. And what is the max you'll give them? $250,000 in that case, right?
That would be the maximum. Yeah.
Okay. Now they sell the property 5 years from now, or they refinance it and they want to take you out and pay you off. How much do they have to pay?
So in that scenario, they could pay either that 1999 safety cap, right? Depending on what's happened with the HPA of the property, right? The home price appreciation, or they'd have to pay 2x that 25%. So it'd be 50% of the home value, whichever one is less.
Okay, well, let's take an example. Say the home is appreciated, right? Yeah. Say that when they have an exit, a refinance or a sale, or they just have cash and they want to buy you out, right? The house is now worth, just for simplicity, again, it's unlikely that this would happen, but say it's worth $2 million. It's doubled, okay? Yeah. So they've got, on the face of it, just assume their loan is interest only. It's still $500,000 is their first loan balance. And yours is $250 originally.
Yep.
How much do they pay you now?
So it'd still be that 50%. So it'd be $1 million or $250 at $19.99 annually compounded. So call that, just for rough numbers, $50,000 for the 5 years. So $250 plus $50,000 times 5 would be another $250. So $500,000. So it'd be the lesser of the $1 million or the $500,000, which is $500K in that case.
Okay, let's make sure we make that clear. The lesser of the $1 million. So there's been $1 million in appreciation.
The lesser of 2x the multiple. So in this case would be 25% initial investment. 2x would be 50%.
Right.
Or the investment that we gave them, the $250,000 at $19.99 annually.
Do you have the calculation on the compounded $19.99 annually? Because we don't know how many years.
Yeah, we can certainly do it. But we call it roughly $500,000 to $600,000.
Okay. So they pay either $1 million or the cap of that 19.99 annually. Do you want to elaborate on this at all?
Yeah, no, that's exactly right. So it's a simple equation that we can either do it live right now, or what we provide actually in our disclosures is multiple HPA scenarios, right, going up and down in home value and time frame. So a homeowner can quickly see kind of the dollar and the percentage that they would actually pay on that.